Although the stock market is still trading at all-time highs, there are definitely still companies out there that are trading on sale. So let's take a look at three of them that can bring you some incredible value and are trading at a discount. The first company we're going to take a look at is Chevron Corporation. You can see over the last 365 days, they're down about 10%, and over the last 5 years, they're only up 27.03%. Now, Chevron Corporation has been paying dividends for the last 38 years and have been growing and increasing their dividends for the last 36. Over the last 5 years, their average dividend growth rate is sitting at about 6.5%, while their dividend yield is chilling out at 4.33%. Here on Snowball Analytics, they have rated the dividend rating for Chevron Corporation to be okay. Basically, this means that if we were to see a recession, that this company is still going to be pretty solid in being able to pay out their dividends and continue to increase them over time, just based on their overall stance in the market. Also, of their profits, they're only paying out 56.72% of the overall profits, which means that they have the ability to continue to pay out that dividend if we do see a decline in the economy. Put together a little spreadsheet here that kind of showcases all the information we went over for Chevron. And the one thing I want to highlight here is the all-time high discount. The all-time high was $182.49, and you subtract the current price, which gets you a 21.05% discount. So you can gain 20% if this returns back to its all-time highs if you purchase at its current price. Now, there's three main reasons why I'm considering adding more of Chevron to my portfolio. One is that 20% discount. Two is the consistent dividend payments they've been making for the last 36 years and increasing those payments. And third is fuel is going to be used even as we do continue to try to transfer more into electric vehicles. It's going to be a very long transition, so gas powered vehicles are still going to be very much so needed, and that is a large source of their income. Now, this next company is one that I do have inside of my portfolio, which you can see here is valued at a little over $37,500. So let's go ahead and take a look at UPS. UPS is currently trading at $135.93, and over the last 365 days, it's down about 11%. Over the last 5 years, it is only up about 17.5%. Now, you might be wondering why I think this is a good opportunity to be purchasing. Well, we're about to go into Q4, where this is where their busiest season is with all of the shipping that needs to be done going into the holiday season. And they also have some pretty impressive dividend statistics, except for the last year because of their financial difficulties. But they do have a dividend yield of 4.8%, which comes out to $6.52 per share that you own. They have their next dividend date on November 18th, and on average, their dividend growth over the last 5 years has been a little over 11%, and they have been increasing their dividends for the last 14 years, even though their last year's increase was only a little bit more than half a percent. So back here on my spreadsheet, which kind of breaks down everything that we just took a look at, with the dividend yield at 4.8%, I mean, that's a great yield to be adding to your portfolio, especially if you are holding a lot of SCHD where the dividend yield is slightly lower. But the all-time high discount is going to be something that is actually crazy. It's almost a 70% gain if we do see all-time highs. And that leads into the three reasons that I'm really liking this stock. And we'll probably be adding more into my own portfolio. The first is that, like I just said, going into Q4, we have the major holidays and major sales such as Christmas, Black Friday, Cyber Monday. There's going to be a lot of things being mailed all over the United States and internationally, so they can pick up a lot of funds that way. Second, they've been paying dividends for the last 24 years, and they've been increasing those dividend payments over the last 14 years. Even when they were seeing a little bit of financial difficulty, they still made it a priority to still increase the dividend by a little bit. And finally, the major gain potential that we could see if we do get back to all-time highs, I mean 70% gains, if we did return back there is absolutely incredible, and I wouldn't mind taking a piece of that cake. Now, this last company I don't quite yet own in my portfolio, but I'm heavily considering it once I dove into the overall statistics. Now, it's Realty Income's little brother. It's going to be Agree Realty. Now, Agree Realty is not one of those companies that is severely on sale. It's on a very slight sale, but what it's able to provide is slightly better than its overall competitors, although it doesn't have the same history that they have. So you can see over the last 365 days, Agree Realty is up almost 38%. Now, over the 5 year, it doesn't look as beautiful. They're down 2.62%, but there's definitely some room for the upside here. Now, the main reason I think that Agree Realty is going to be a great buy right now is they have a dividend yield at 4.01%. They have a dividend growth rate on average over the last 5 years of 5.6%. And they have a dividend growth streak of 11 years, and they've been paying dividends for 12. Now, when you really get into it and compare to the number one competitor that they do have, which is Realty Income, if you look at the 5 year, it's at 5.6%. Now, if we jump over to Realty Income, that's only at 3.55%. Now, these trade very, very similarly. As you can see, the payout ratio of Realty Income is at 74.32% compared to 74.74%. So there's a very, very small difference between their overall payout ratios. But the main difference you're going to see is the dividend growth streak, and the overall amount of time that they've been paying dividends is a lot shorter on Agree Realty than Realty Income, when Realty Income has 27 years under their belt of constantly paying dividends. And we're back into the spreadsheet that I have made. The all-time high discount is only about 4%, but the three main reasons that I will be adding this to my portfolio is one, it's growing its dividends faster than ticker symbol O, which is Realty Income. And the same with Realty Income, the lower interest rates that we're seeing as the Fed continues to reduce the rates, that allows them to expand their portfolio a lot cheaper, which means they can do it a lot faster. And finally, it's going to add a monthly payer to your portfolio, as us dividend investors like to see that passive income coming in. And if you're getting paid every single month, that's just a little cherry on top of the 4% dividend rate that it already has. I really hope you found some value in this video, and maybe we'll be adding one of these three companies to your overall portfolio. And if you want to stay tuned for the next portfolio update that I'll be coming out with, hopefully I will be over $38,000, and I'm planning on hitting the $40,000 mark by the end of the calendar year. So make sure to stay tuned for that, and I will see you all in the next video. Peace.